All right, let's talk about money. We're always told the same things, right? Save more, invest early, work hard. But what if those are just the rules of the game? What if the real winners are playing by a totally different set of principles? Today, we're going to pull back the curtain on the 7 unspoken laws that actually govern how money works. Does this feel a little too real? You're doing everything you're supposed to do. You're saving your money, you're responsible, but when you look at your account, it just feels stuck. It is so frustrating, and honestly, it's because you might be playing a game with a rulebook that isn't actually designed for you to win.
And this is the big idea for today. The difference here is absolutely crucial. See, rules can be bent, they can change. They often favor the people who made them. But laws are fundamental. They're like gravity. You can't argue with them. And once you understand them, you can use them to build real, lasting wealth.
So let's kick things off with the first law. And honestly, it's the most important one. It's the biggest mental shift you're going to have to make. It is all about the relationship between speed and time and knowing exactly when to use each one. Okay, so here's the key distinction. Money loves speed. It's all about transactions. The faster you can see a deal, pounce on it, and close it, the faster money flows. But wealth? Oh, wealth is different. Wealth loves time. Real, life-changing wealth isn't built on 1,000 quick flips. It's built on making a few great decisions and then letting the most powerful force in the universe, compounding, do its thing for years or even decades. Let me just paint a picture for you of how this actually works. Let's compare 2 people. You've got the flipper, who's all about speed, right? Chasing that quick cash. Then you've got the builder, who's playing the long game. The builder starts with just one property. Now, fast forward 5 years. The flipper has a nice pile of cash from 100 deals, which is great. But the builder used that time to let their equity grow, and then used that to buy more units. Now they own 20 units and have a net worth 5 times higher. The flipper was making money. The builder was creating wealth. And if you need any more proof about the incredible power of time, just look at Warren Buffett's Berkshire Hathaway. From 1965 to 2024, their strategy was simple: buy great companies and wait. The result? An astronomical 5 million% return. That's not a typo. That is the ultimate proof that wealth absolutely loves time. Okay, so once that clicks, that time is your secret weapon. Everything else starts to fall into place. Now you can start thinking like a builder. This is all about being in control, using the right tools, and understanding what you're actually building towards. So let's jump into law number 2. Law number 2 is powerful and simple. He who gives the money has the power. I mean, just look at how the richest people on the planet got there. This chart tells you everything you need to know. How many people made the Forbes 400 list from their salary, from just their earned income? Take a guess. The answer is 0. A big fat 0. A few got there by selling a business they built, but the vast, overwhelming majority, they are buyers and builders. Think Musk, Bezos, Buffett. They get it. Real wealth comes from owning and building assets, not from trading your time for a paycheck. Which brings us right to law number 3. Leverage multiplies everything. It's the builder's best friend. Look at this super simple real estate example. Let's say you buy $1 million house with all your own cash. It goes up by 100 grand. You made a 10% return. Not bad, but now watch this. What if you use leverage? You only put down $200,000. That same $100,000 profit is now a 50% return on your money. Same house, same profit, but a 5 times better result. That's the magic of leverage. And this isn't just some little trick for you and me. This is the engine that drives our entire global economy. Trillion-dollar industries like private equity exist for one reason and one reason only: leverage. It's how they can buy huge companies, make them better, and grow them, all while using other people's money to juice their returns. Without leverage, our economic world would grind to a halt. So you're using time, you're using leverage, but to what end? This brings us to law number 4, and you have got to get this one straight. You have to know the difference between cash flow and equity. Cash flow is your today money. It's what pays the bills, funds the vacations, it keeps the lights on. It's important. But equity? Equity is your tomorrow money. Equity is your freedom. It's your ownership stake. It's the part that grows quietly in the background and builds your actual wealth. And here is the perfect, most brilliant example of this idea. We all think McDonald's is in the burger business, right? And sure, they are. That's their cash flow. But what's the real business? It's real estate. They are one of the biggest real estate owners in the entire world. They use the money from burgers to buy the equity in land. That is the builder's mindset in its purest form. All right, now we're getting into the more advanced stuff. Once you have this solid foundation, it's all about how you approach risk. And here's the secret, it's not about avoiding risk. It's about taking smart risks, where the potential win is just ridiculously bigger than the potential loss. Law number 5 is about something called asymmetric upside. It's a fancy term for a pretty simple idea. Your potential gain is way, way bigger than your potential loss. Think about how a venture capital fund works. They might make 5 investments. They fully expect 2 of them to go to zero. One might break even, but then one returns 10 times their money and one returns 100 times their money. Those 2 huge wins don't just cover the losers. They create massive returns for the whole fund. They bet a little for a chance to win a lot. But, and this is a huge but, this idea can be incredibly dangerous if you don't combine it with law number 6. This might be the single most important rule for survival. The goal isn't just to win big. The number 1 goal is to make sure you never, ever get kicked out of the game. I have to tell you a quick story about a friend of mine. It's a tough one. He put his entire life savings, we're talking over $700,000, into a single oil and gas deal. It looked like a sure thing, but it went sideways, and he lost everything. 15 years of work, just gone. Now, was it a bad investment? Maybe. But that's not the lesson. The fatal error was the size of his bet. He risked the entire empire for one shot at a pot of gold. So how do you avoid a disaster like that? That brings us to our final law, number 7. Diversification is a hedge against ignorance. Now, Wall Street will scream at you to diversify everything, but then you look at the wealthiest people, and they're usually super concentrated. What's going on? Well, this little chart explains it all. When you understand the risk and you have control, like in your own business, you concentrate your bets. But when you don't really understand it and you have no control, that's when you diversify, like buying an S&P 500 index fund. You're basically admitting you don't have an edge, so you spread your bets out. Okay, we have covered a ton of ground. 7 laws that can totally change how you see money. But look, knowing this stuff isn't enough. You need a system to actually apply it. So let's turn all these laws into a practical, simple tool you can use for every single financial decision you make. And here it is, your 5-question checklist. Before you put a single dollar into anything, you ask these questions. 1, can this compound over time? That's law number 1. 2, who's in control here? That's law 2. 3, what happens if this thing goes to zero? That's law 6, survival. 4, is the upside way bigger than that downside? That's law 5. And finally, number 5, do I actually truly understand what I'm getting into? That covers law 7. This checklist is your system for putting the laws of money into practice. So there you go. We've gone from being a rule follower, just doing what we're told, to understanding the fundamental laws of how this all works. You now have the framework to think not just like someone who earns or saves, but like a builder. So the only question left is, what are you going to build first?